Hi, everybody. Thanks so much for joining in our economic update video. In today's video, we'll look back at the past quarter that occurred, as well as a current look at the markets, economy, and what we see for the rest of the year going forward. So again, I appreciate you taking the time to join in. So as we look at the spring 2024 economic review, we always want to remind folks that we view knowledge as power. As we're going through uncertain times of a market and the economy and elections, it's always helpful to understand under the hood what's happening in your portfolio and the environment. And that tends to give folks confidence in their plan and how to weather through different periods. So we appreciate you tuning in on this video, and we hope to shed a light of some of what we're seeing out there currently. So when we look back at the first quarter, we had very strong performance in the markets, continuing a really strong fourth quarter of 2023. April, we saw a little bit of a pullback, but May has started out very strong, and we're back to all-time highs at this point. And we've seen a lot of momentum since the Fed indicated they've paused on the rate hikes that we saw throughout the past year and beyond, and now are looking forward to some rate cuts in the future. That has given both equity and bond investors a lot of hope and positivity with a view that this rate cutting and kind of more slowed down central bank activity is coming near an end, and we'll hopefully see some tailwinds in the market going forward. And so the first quarter, we saw the S&P 500 return over 10%, the Dow Jones over 5.5%, and again, after a little bit of a blip in April, we're back to those high levels. Really a theme that we've been really focused on, and all outlets have been focused on for the past year and a half, 2 years now, is where interest rates lie. So the Fed did not raise federal fund rates so far in 2024 after several rate hikes throughout 2023. And we continue to see short-term interest rates at that target range of 5.25% to 5.5%. In past Fed meetings, they've also indicated that we could be getting close to rate cuts, as I hit on. And while we haven't seen any rate cuts to date, we haven't seen any rate hikes either. So it's been a bit status quo. What's interesting is we've seen a change of tune a little bit this year, where at the start of the year, investors were anticipating 7 rate cuts through the year. So far, that has not happened, of course, where we haven't seen any rate cuts. And so we continue to see adjustments down. So it's unknown whether we're going to see 2 rate cuts this year, 1 rate cut, no rate cut. Time will tell. But it does seem likely that we're at least over that rate hike tenor that we saw in the past year and a half. So when we think of interest rates, we really need to look at them in tandem with inflation, and the two really work side by side. When we see high inflation, it really holds the Fed and the central bank to the fire, where the way to deal with inflation is to slow down the economy, raise rates, reduce stimulus. And so the track of inflation is really, in our view, going to drive a lot of what interest rate policy looks like. And so from the peaks back in 22, where inflation was north of 9%, scraping close to 10%, the largest numbers we've seen since the 1970s, early 1980s, we've seen inflation dramatically reduce down from that point, where it reached the low 3% level in this past year. That has been tremendous progress, and one of the reasons, in our view, we've seen the market bounce back and respond so positively. With that in mind, this is something to continue to watch, because in the past 9-10 months, we've seen inflation sort of get stuck at that low to mid 3% level. And then January through March, inflation actually started ticking up again, which gave investors some pause. In April, we saw a slight downtick to 3.4% annual inflation from 3.5% the prior month. But we do think that's still positive that we've seen things level and hopefully tick back down. Nonetheless, 3.5% inflation is much improved over 9-10% inflation, but still that's nearly double what the Fed's 2% target is. And so while we're seeing a lot of folks get excitement about rate cuts, again, from our perspective, we'll likely need to see a bit more progress on the inflation front for those rate cuts to really transpire. So this is something that we're really focused on throughout the rest of this year and beyond. With the last meeting, occurring April, May, where we saw another hold in rates, that is now 6 consecutive meetings without a rate cut. Again, at one point, it was anticipated we'd see rate cuts early this year. And so we will continue to track this as we go along. A lot of folks are saying, well, why don't we just wait until inflation's all the way back down to 2% and then the Fed can cut rates at that time? It's a bit tough to hit the nail right on the head. And an analogy to that is when rates are cut or increased, it takes some time to work its way through the economy. So for example, we're still just starting to see the more recent rate hikes, from late last year, and it's going to take a while till that's fully felt. And an analogy from our perspective, it's sort of like steering a cruise ship, right? So when you're turning around a big ship, ocean line or a cruise ship, you can't just turn on a dime. You need to have some leeway and headroom and runway as you do that. And so it really puts the Fed in a tough job in terms of not keeping rates too high for too long and slamming the economy harder than needed, but at the same time, not letting inflation stay out of hand or come back again, as we saw in the 1970s, for example. Something interesting is that despite no rate cuts this year, again, as I noted, at one point there's hope for 7 rate cuts, and so far we haven't seen any in 2024. The stock market continues to really be strong and hit positivity and new highs and charge ahead. So as you can see on this chart here, despite the no rate cuts kind of occurring and kind of hanging at that current level, and the expectation continuing to drop from that 7 to the 2 to 3 now that we're looking at. That's a dark blue line. So again, at the start of the year, the market was anticipating 7 rate cuts. Now we're under 3 to that 2. The stock market continues to charge forward. This is a bit interesting because typically higher rates are a bit of a headwind for the market and make valuations more expensive when you compare them to how much you could earn on bonds or money market or treasury bills. And so this is something to watch. We may see the market continue to have some momentum and be a little ambitious despite the slowdown in rate cut expectations. And so this is something that we're considering as we're timing rebalances and allocation in the portfolios. So when we think interest rates going up or down, it always brings us to that old adage, when rates go up, bond prices go down. When rates go down, bond prices go up. And as we've seen the last couple of years, with interest rates going up dramatically from essentially 0 to over 5%, that has been very painful for long-term bond holders that have been exposed heavily to those interest rate changes. If and when we do see rates come down, likewise, bond investors are hopeful and optimistic that they'll then get some positivity and positive return in relation to that. One silver lining with interest rates going up, again, as for folks that are retired or close to retirement, it's sure refreshing earning 5+ % on your bond investments, which is night and day from what we've seen for the past 15 years or so. And so as of the start of May, 2-year bonds were yielding just under 5% a year. Treasury bills are yielding north of 5% a year. And again, this is viewed as a risk-free asset. And 20-year bonds, we continue to see the rates increase. And now those are now yielding 4.8, 4.9% a year as of May 1st. The way a 20-year bond works versus a 2-year bond is a bond is like a loan. So if you're purchasing a government bond, you're loaning money to the government, and you're going to collect that yield, that income each year. When interest rates go up, if you have a 20-year bond that was only paying you 3%, and the new ones are paying 4.85%, your 3% one's not worth as much. People would rather have the new ones that pay a higher yield. And that's why the longer the term of the loan, of the bond, the more sensitive it's going to be to interest rate changes. We continue to see very good value in the short-term bonds, where you're getting that nice 5% or so yield pickup with the risk-free rate, without the risk of long-term bond exposure if rates did go up higher, for example. One more thing to mention here. So since the inception of the Bloomberg Bond Index decades ago, if you look back, over 90% of a return of your bond investments is going to be the income component, that yield. And then the remainder comes from price going up or down as a result of rates going up or down, right? And so when we think of bonds, those are those war chest investments. So we want to match it to the risk profile and the term of your needs in your portfolio. And we really are primarily focused on that income component, which is very healthy right now. So again, a silver lining of interest rates going up. We continue, as noted priorly, see short-term bond yields yielding more income than longer-term bond yields. And so this is what's called an inverted yield curve. And as a result of this, we've seen one of the longest periods consecutively where we've had an inverted yield curve on record, where short-term bonds, return more than longer-term bonds. As you can see on this chart, that dark blue line at the top is the current, what they call a yield curve. So on the far left, you can see short-term treasury bills, one-year bonds are giving you over 5% income per year. On the far right, a 30-year bond is giving you more like 4.8% per year. And so while it's catching up, we're still earning more interest on the short-term bonds, which is not typical. Generally, you get rewarded with a higher return on the longer-rated bonds. The green line is where interest rates were a year ago. So we're seeing much higher yield in the past year. The dark gray line is where interest rates were back in 2022. And so you could see at that level, interest rates were much, much lower at that piece. And that actually indicates kind of more of a longer term average as well, where short-term rates are lower than longer term rates. But again, in our view, there could be good return buying longer term bonds. If rates go down, you'll get some appreciation there. But we primarily view bonds as that conservative war chest, short-term bucket in your portfolio. And so we continue to see a lot of attractiveness in collecting that over 5% interest risk-free without taking the long-term maturity risk there. So this is something that we continue to be very pragmatic on. Again, a positivity of interest rates going up is earning 5% on your cash is a pretty good deal. So that Fed funds rate, which you're able to accomplish with treasury bills, as we do for many of our clients, is at about over 5% yield right now. A lot of the banks have not caught up to this still, and financially, they're not in a position to. So as you look at this from Barron's as of April, the average bank money market was still well under 1%. In 12-month CDs only yielding under 2%. And so if you're not earning a lot on your excess cash beyond your normal checking account cash, yes, at some point we'll probably see rates go down, but I don't know, as we've seen, it could be stickier than people thought. And for the time being, earning 5% on your excess cash is a very good deal in our opinion. So give us a phone call if you feel like you're not getting everything you should be from a yield perspective here. Okay, so with all that said, we get the question a lot, are we due for a correction? Is there another market correction on the horizon? Feels a little too good to be true as the stock market continues to power up over the past year and a half. And when we think of a correction, that's defined as over a 10% decline in the stock market. And these, while they could be uncomfortable, they do tend to happen. Most years, we typically see at least 10% correction. And there's a lot of factors out there that can result in this. If we see inflation start ticking up again, if there's worries about recession or company profits going down, if it looks like the Fed's not going to cut rates for a while, you can absolutely see market reaction as we saw in April. With that being said, these are short-term parameters and short-term things to watch. And we view equities in the stock market as longer-term investments. And so the key is sticking to your plan, and that positions you to weather through any of these periods if we do see a correction at some point, as we surely will, as we do just about every year. One kind of positive look at history is that this chart goes back to 1954. And as it shows, in years where the first quarter stock market performance, S&P 500 exceeded 10%, that tends to bode well for the rest of the year. So of the times, the 11 times going back to 1954, where we saw 10% plus stock market like we have this year, 9 of those 11 times, the second quarter was also positive. In addition to that, 10 out of the 11 years ended with a positive return when you had that strong first quarter, with the average being an 11% return for the year. What's interesting on that far right column, every single time of these, despite 10 out of 11 times the market ended up in the year, where again, similarly, when we had a 10% plus performance first quarter, every single time we saw a pullback in the market at some point. And on average, the pullback in the market, the correction was 11%, like we see most years. And so again, even if we do see some volatility at some point, that doesn't mean that we're necessarily going to be in another big market drop or a bear market. These corrections tend to be short-lived and happen just about every year. So something that we want to be prepared for. So if and when it does happen, we understand the history there and that it is normal and not something to get overly concerned about. But again, it is positive to see. Let's hope this trend continues where that good first quarter continues on to the rest of the year. And one last, kind of chart showing that. So this is one of my favorite charts. This goes all the way back to 1980. So basically 45 years. And the dark gray bars are year by year what the stock market performance was for the year. And so as you can see, about 75% of the time, 33 out of the 44 years, the stock market ended positively and generally by quite a margin. What you can also see is just about every single year, you see those red dots. That is the maximum pullback that we saw during the year. So on average, the stock market drops 10% at least once a year, despite ending the year positive near 10% on average. And the average annual drop's actually 14% on this chart if you look at the 44 years. And so far we've seen a 5% drop in April. The markets climb back. But again, if we do see a correction, it's very normal, right? And it's something that we typically see. So it's helpful to look back at the history and see how that is commonplace. I know I'm doing all this talk about corrections. Again, we could very well see a really strong remainder of a year, right? We have strong momentum. Company profits have been outperforming. There's a lot of good things. But it is good as we go through these periods, take a step back and just prepare that volatility is normal and something that if it comes, we have a game plan to weather and get through. As we've kind of seen, there's been no shortage of headlines in the market for the last many, many years. And it's really been dizzying going through the past years of COVID, high inflation, now the wars abroad, election concerns. And we're going to continue to see more and more of these headlines. We live in a day of age as well where the media really magnifies this as it grabs eyeballs. It's like watching a car crash. And with everyone's phones and tablets and all the TV and news channels, we just live in a high anxiety world, right? And that's one factor there. And so this is something we continue to monitor. We do at the same time want to make sure we're differentiating a lot of the news headlines from how it actually impacts the economy, the stock market, your investments. But if you have uncertainty, if you read something that's uncomfortable, we're here on your team to share kind of what we're seeing, our thoughts, provide feedback. So never hesitate to contact us. These are conversations that we really enjoy having with you and we stay very tuned in on. So something just for us to continue to be aware of and ready for. And then, I include this slide just about every presentation we do. But again, stock market is about long-term investing. And we're going to see bumps in the short term, week to week, month to month, quarter to quarter, year to year. But as you look at a bit longer periods, you tend to see the stock market and the growth of the companies and the profits and the technology really overcome. And for example, if we look back at the last 3-4 years going through that COVID drop, the inflation drops, all the election concerns, despite that, we're sitting at a point where we've seen really decent market performance during that stretch, despite a bear market, 2 bear markets with the COVID drop, everything going on. And so again, the stock market are long-term investments, and we plan and prepare your portfolios acknowledging that. And so that's something that we're really, thoughtful on. This is a good time with the market at an all-time high as we're doing to review your investments, make sure we're at the right risk profile. these are great times to do rebalances, as we've done recently. In May, we did a rebalance, for example, across retirement accounts for clients. And again, the whole idea is as we see nice gains in the market, that's a great time to take some profits, refill your bonds and your war chest where your draws come from. And then likewise, if we see drops in the stock market, that's a good time for us to look for opportunity. Can we buy low? Is this a good time to rebuy some stocks and bring up to our target allocation? And so this is something we're always very proactive on. We make sure to personalize every client's portfolio to their needs and comfort zone. But if you ever have a question, if you want to review your portfolio on top of our kind of regular touch bases, please contact us. We'd love to have that conversation with you and kind of review that with you as well. So again, long-term investments, we're very optimistic that over the next, several years in the long term, we'll continue to see the stock market provide great growth opportunity as it has done for the past several centuries, right? Okay, so as we recap this economic market update, a few takeaways I'd take back with you as kind of items to remember. First off, we're not out of the woods on inflation. It's great. We've moved out of the red danger zone from that 9-10% inflation to the threes where we are now. But we still are way far off from the Fed's target. Again, nearly double what the Fed's 2% target is. And so this is something that we'll want to continue to watch. The third bullet I noted, the Fed indicated we could see rate cuts this year. I do think that's likely we'll see a rate cut or two. But if inflation continues to stick in that mid 3% zone, there's a good chance that doesn't happen. We may not see a rate hike, but we could see the Fed continue to hold rates where they are higher for longer. So that's something we want to be prepared for. Inverted yield curve, we continue to see higher returns on short-term bonds versus longer term. So this is something that we're really being thoughtful of to maximize your bond portfolios. And and again, we're due for a market correction. We haven't seen a 10% correction this year. They typically happen most years. There's a lot of factors and news headlines that can lead towards that. But again, these are normal things. So if and when that does occur, whether it's this year or next year, just remember we have a plan to weather these periods, and it's something that we do expect. So not something to fret too much over. I do think we'll continue to see volatility, lots of news headlines coming on. So again, we're here as a resource for you. If you want to discuss something you're reading, if you have questions, please reach out to us anytime. And again, we have great plans set up for you and our clients. We are prepared to weather the uncertain periods. We're ready for the curveballs. So again, we got a good game plan. We're going to stick the course with that. If you have any changes in your life, please let us know so we could discuss that to make sure we keep outfitting your portfolio specific to your needs. But again, we have a great plan in place to get through these periods. So I really appreciate you taking the time to tune in. We'll keep these economic updates going. I get a lot of great feedback, so thank you for sharing that. We appreciate you and we are here for you. I also do want to note, join our Client Ambassador Club. One of our goals this year is to help more clients like you. And we are growing, our team is growing. So to be part of our Ambassador Club, introduce us to someone that you think may benefit from our services. Bring a guest to one of our educational events. We do those throughout the year. But we'd love to meet people, especially those that you think could benefit from working with us, benefit from talking to us, that we can help. We're going through very uncertain times, right? And we just want to make sure the people that you care about are getting the help they need and deserve. So please make an introduction. We'd love to talk to anybody that you care about. And again, thank you for tuning in. One of our primary goals is to keep clients informed, and we appreciate you watching this update. And call us anytime if you have any questions. So thank you again. Look forward to talking to you all soon. Take care.